let's take a look at a chart to really be able to identify where it is that we're going to get out in the off chance that we might be wrong. Here we're looking at a symmetrical triangle of sorts. Some might even call it an ascending triangle. Again, the name is less relevant. What's important here is that we have a prior uptrend in place, a healthy digestion of those gains, very well defined below a downtrend line. This is the resistance above, representing the overhead supply. Once we break out above that resistance, that's our signal, remember, that the ongoing uptrend is ready to resume. So if we are to buy this breakout, the stop loss becomes simple. We only want to be long this stock if we're above the downtrend line representing the upper end of this range. So if prices were to fall back below that level, all bets are off. So from a risk-reward standpoint, we want to enter the marketplace as close to that breakout as possible, because we'll know we're wrong very quickly. We want to know when we're going to be wrong, and we want to know where we're going to be wrong. And if we can learn that sooner rather than later, that's even better, because that saves some opportunity cost. Legendary investor Larry Hite said it best: if you don't bet, you can't win. And if you lose all your chips, you can't bet. So I think what Larry is trying to say here is position size responsibly. Be aggressive. Look for opportunities. Don't just sit in cash. Look for trades to invest in. But look for risk-reward opportunities that meet your time horizon, your risk parameters, your overall goals. They're different for all of us. But while doing that, we need to position size accordingly. We can't let one bad bet ruin us completely. We're willing to take some paper cuts, but that one bad trade that wipes us out, that's what we're trying to avoid.